I'm Emily Chang in San Francisco, and this is Bloomberg Technology. Coming up, tech earnings continue. Twitter reporting user growth misestimates. LYFT, meantime, dropping 44% its revenue there. And while Cisco tops the street expectations and reports software numbers for the first time, the company failing to make sales inroads in other areas. Shares declining after the bell. Plus, some of the biggest names on Wall Street and in Silicon Valley, names like JP Chase, Advent International, Khosla Ventures, are pumping billions of dollars into mom and pop shops, selling everything from tea kettles to itch remedies on Amazon. We're going to talk to someone snatching up the up-and-comers in hopes of creating new global brands. And self-driving upstart AURORA does a big deal with Toyota in addition to Uber. We're going to hear from CEO Chris Urmson about when driverless cars will become a mainstream reality. All those stories in a moment, but first, U.S. stocks halting a 6-day winning streak. Investors debating whether commitments from the Fed and the Biden administration will let the economy run hot and spark destabilizing inflation. Bloomberg's Kriti Gupta has more. Kriti, walk us through the day.
Well, hi, Emily. Let's just kick it off with earnings, because that seems to be the big story after the market close. Kicking off with Twitter in particular, you saw revenue actually beat estimates. The company citing stronger brand advertising demand. Of course, shares appreciating that in post-market trading. But of course, the company in line with some of those other big tech companies, warning of slower user growth. Switching over to Cisco, you're seeing those shares under pressure in post-market trading. Its earnings beating expectations as well. Was their top-line business that had some investors worried, showing some pain as people switch away from data centers into cloud services. And then back in the green for LYFT, you see those shares rallying just shy of 9% in the post-market after a 44% drop in fourth quarter revenue off that pandemic hit. Now, that sounds like bad news, but it really is actually good news, given that even with fewer customers, you did see them get more revenue. Now, switching over to what happened today, really big tech led the way. You saw a little bit of a step back for the S&P 500, but the New York FANG index, as shown on the screen, up 1% in market trading. This, of course, really tells you that some of those big tech names are still catching that investor bid. And Emily, we can't talk about markets without hitting either GameStop or Bitcoin. Today, it is Bitcoin's turn. I just want to switch over to a 1-month chart, a 3-month chart on that. Bitcoin crossing the 48,000 level in intraday trading today. This, of course, coming off some of the comments from Elon Musk yesterday, as well as that Tesla investment. But it's also this narrative in the market that there is this search for returns. So you're seeing some of those alternative assets, some of those riskier assets like Bitcoin catch quite a bit. And this is, of course, after we've seen quite the drop in credit spreads as well. Emily.
All right, Kriti, thanks so much. We're going to continue to follow these results as more numbers roll out. Cisco also highlighting $3.6 billion in quarterly software revenue. I believe this is the first time ever that they're breaking out software revenue, but no growth in revenue overall. So something we'll continue to follow there. Meantime, Reddit has announced it is raising $250 million from private investors, riding a wave of attention after users of the social media site drove a stock market frenzy. For more on the details, we're joined by Bloomberg's Priya Anand. So Priya, is this based on fresh interest in Reddit as a result of the news cycle, or has this been a long time coming?
I mean, clearly Reddit has gained so much attention in the last couple of weeks. You have to think that was part of what influenced this kind of deal here, that they're capitalizing on all this attention right now, which is, sometimes the best time to raise money, right? And this gives them a $6 billion valuation, which is up from their $3 billion valuation that they got in roughly early 2019.
That said, how do they plan to continue to make money? I mean, that has always been Reddit's struggle. How is the advertising business going, and are there any other streams?
Reddit said when they announced this fundraising that their advertising revenue actually went up 90% in the last quarter, so the quarter ending December, compared to the year prior, which seems like a lot. And they said that they're going to use this money to build on that and to build on their video efforts. They acquired short-form video platform Dubsmash. And they also said that they're basically planning to double their staff this year to about 1,400.
So what's actually happening inside the Wall Street Bets thread at the moment? I mean, the conversations we've been having, it sounds like this kind of activity, the power of the retail investor is here to stay. And is that, momentum that they're banking on?
Reddit's CEO has given few interviews, just basically one interview to the New York Times about this. We've been asking here at Bloomberg as well to hear their thoughts on all this and what Wall Street Bets really means for the company. But he has said that this kind of platform is something that is, like peak Reddit, basically, that it's among Wall Street Bets is among his favorite forums on the platform. And, they're really leaning into this, right? Clearly Wall Street Bets, Steve Huffman even called it the glue that's tying most of America together right now in an interview on Clubhouse, the social media app, a couple weeks ago.
So, I wonder if it's not just Wall Street Bets. Do we see that activity bleed into other threads, other kinds of threads, or is it really about that particular group itself?
I think they view Wall Street Bets as sort of a culmination of everything Reddit's long been about, right? I mean, back in 2007, Reddit was involved in helping to name this humpback whale that Greenpeace was trying to name to raise awareness about hunting by Japanese fisheries. There's this campaign, like, what do we name this whale? And this Reddit thread started saying, let's name it Mr. Splashy Pants. And it really sort of took over the internet and hijacked the Greenpeace campaign and ultimately led to that being the name. And the story is sort of an example of how, Wall Street Bets, we're seeing the widespread effects of that right now. We've seen the stock market run zero the last couple of weeks and how things can really take off on Reddit in different areas. And this is sort of peak Reddit. It's been something where we've seen people, organize on the platform to have real world effects from, naming this little whale campaign that Greenpeace had to, in the real world, Reddit's had to ban forums related to Donald Trump supporters after the violence at the Capitol. And then also last year, a separate forum for inciting violence. And so we've seen that these internet campaigns can have real world effects. This is just sort of the financial version of that, right? We've seen the impacts in the political sphere for some time now.
Right. And obviously there are certainly risks involved with that for a company like Reddit that's trying to build a business as well. Bloomberg's Priya Anand, thanks so much for your reporting. If you catch up with Steve Huffman, let us know. We'd like to speak to him as well. Okay, coming up, Wall Street Bets on Amazon Small Business. I'll be speaking with longtime venture capitalist and co-founder and president of Branded, Michael Ronan, about why his sights are set on mom and pop shops. That's next. This is Bloomberg. Wall Street is cozying up to Amazon sellers, investors increasingly eyeing popular mom and pop brands on the marketplace in hopes of scaling the company or acting as a lifeline for sellers who just don't have the resources to grow their businesses outside of their garage. These so-called Amazon aggregators have surged in the last quarter as more and more venture capitalists are betting big on the average Joe or Jane's home-based business. For more, I'm joined by Michael Ronan, co-founder and president of Branded, who was previously the founding partner of SoftBank's Vision Fund. Michael, thank you so much for joining us. So you've got money pouring in to these mom and pop shops, not just from folks like you, but what is so appealing about this idea?
Well, I think what's appealing is a vast marketplace that Amazon has invested in and made very vibrant and a massive community of entrepreneurs that are building businesses and growing. So this is a marketplace in the US alone is 200 billion and growing at 50% year on year. And is really crying for help, if you will, from companies that can help scale it further. And so, as you said, these entrepreneurs have done a great job getting from 0 to 1. And folks like us at Branded can help them get from 1 to 10 to 100. And I think the opportunity is just amazing.
So what kind of Amazon brands have you purchased? How do you find them? How do you choose?
So we've purchased and partnered, in some cases, partnered with the founders. So actually purchased control, but left the founders as partners of ours. Businesses in several key sectors that are, again, big sectors on Amazon's thriving marketplace. Home goods, kitchen, sports and outdoors, leisure. These are massive categories that have gone significantly stronger over the last several quarters, obviously in the back of COVID. But it's not just a cyclical trend, it's a secular trend. And these are the type of products and businesses, and most importantly, entrepreneurs, where we can build long-term value by investing in the brands, bringing product capabilities and marketing capabilities, and design and creativity to all the work they've done. So we're going to continue investing in these sectors.
So how do you view the risks about being associated with only one, yes, massive, but just one platform?
Well, when you have the biggest e-commerce platform in the world as effectively your partner, when they've done the hard work of putting in the physical infrastructure, literally hundreds of billions of dollars of warehouses, and then connected more than 100 million homes in the US to Prime, it's both the biggest opportunity, and of course you have to treat it with respect and caution. And so I think there's complete congruence of objectives. Amazon wants to find the best products for its customers at the best price with the highest quality. We have over 700,000 reviews. They're by and large incredibly positive. And as long as we do our business well and help the best become even better and provide great selection, good products and great customer service, I think this is all upside for them and upside for us.
That said, Amazon is facing scrutiny from Washington about how it treats third-party sellers, the data that it gathers, data that it uses potentially to create its own products. Do you have any concerns about that, Amazon isn't just your friend, but could, in some future world, be your competitor?
Not at all. I think, again, we're a tiny fish in a massive ocean that Amazon has created. With all respect to our success, which we're very proud of, our revenues are still in the hundreds of millions, and as I just said, their marketplace in the US alone is north of 200 billion. So I think we have a long way to go before there's any type of even hint of conflict or misalignment. And again, I think obviously they have a massive company and they've built an incredible ecosystem. And if they can find partners like ours who treat that marketplace with respect, abide by their rules, and actually help them create great brands and great companies for their consumers, I think I really don't see an issue.
Are there any more favorable sectors in particular, or kinds of companies that you think will do well with this model, whether it's toys or health and beauty or tech gadgets? Yes,
some great ideas there. So we can talk offline if you'd like to join us and help us find some of those. but I think that one of the common denominators of some of those that you've mentioned is our name is branded, and it wasn't picked up by coincidence. We do believe that long term, to create real value, we have to find the ways to create emotionally connected brands to consumers. And so while we're going to be active across the marketplace, regions and products, et cetera, the long-term value will be created when you create and help the entrepreneurs, frankly, build enduring brands where people can relate emotionally, not just qualitatively to their products. It starts with great reviews, but it has to continue with great design and great customer service and great products that keep being updated across the categories.
Have you had any business owners who've said, thanks, but no thanks. I like owning the relationship with my customers, and I don't really want to give up that power?
frankly, those are the ones that we'd like to talk to the most. It's the ones that the best partners for us, the best business owners that either will sell to us or partner with us by keeping some of their equity in their business are the ones that are so emotionally connected to what they've built, but really are running out of runway. You know, it's hard for them to finance the working capital. It's hard for them to find the global resources to work internationally. It's hard for them to do marketing, et cetera. But they don't want to give up. So those are the ones, and we've done a few of those where we can partner with and help take them to the next level, bring them the resources that a big company like ours can bring and do the best with. So those, we love those. We'd like to talk to as many of those as possible.
And let's say, you buy up, 9 of the 10 mom and pop shops selling one particular brand of stuffed animal. Just thinking, because I've got a lot of kids and something I'm often looking for, found it to be a disparate experience on Amazon. There's not like one company to go to. But, then there's this last company that doesn't want to sell out, but then doesn't have the power to take on a bigger entity or combined entity. Is that in the end then not good for small business?
I really don't see it that way. Look, this is the modern version of the thriving marketplaces that existed in every city, either farmers markets on the weekends or market streets and whatnot. This is, if you really step back and think about it, what Amazon has enabled is small businesses flourishing online. And it could not have come, obviously, at a more critical time than the time we're in now. So again, as much as we'd like to feel good about our start, and it is an amazing start, we have a long way to go until we create a big enough footprint that we really tilt the market in any way. And importantly, every year, and this is one of the amazing things about this, every year there's new merchants coming in, younger, hungrier, more creative entrepreneurs that are coming in. And I think we would love to, some of them will remain independent, some of them will partner with us. And I think what you'll see, and I think the most important benefit to consumers is, just as you said, there will be some where you're going to have actually a meaningful relationship with, because you've had a great experience on Amazon with, and you want to come back to as you search for new things, and some new ones. And as always, you'll diversify and find what you like on Amazon, which is what their mission is.
All right, I'll be watching, or I should say shopping. Michael Ronan, Branded co-founder and president. Really interesting strategy you have. Thanks so much for joining us today. Also founding partner of SoftBank's Vision Fund. Meantime, as we were speaking, some big news. The Senate has officially voted that President Trump's impeachment trial is constitutional and will move forward. 6 Senate Republicans voting in favor of the trial continuing. Of course, the debate was whether or not it was constitutional to impeach a former president, but the Senate now voting to move forward with the trial. It will resume at noon Wednesday. All right, coming up, a mixed picture from Twitter and Lyft reporting earnings after the bell. Even though both companies beat earnings, fewer users and fewer customers are impacting after hours shares. We will have a breakdown next. This is Bloomberg. Twitter and Lyft just reported fourth quarter results, and while the social network's revenue topped estimates, it added fewer new users than projected and warned that audience gains in 2021 will slow. Meantime, Lyft inching closer to break even and squeezing more revenue out of each customer as a result of deep cost cutting. Our Ed Ludlow has been diving into the numbers. Let's start with Lyft. Ed, what are the headline takeaways here?
It's really about belt tightening, as you said. Rides are obviously down, and there's uncertainty on when people will go back to ride sharing. Part of that is linked to the vaccine rollout. It's just unclear when people are going to be comfortable doing so. But Lyft's gone through this process of cutting costs in 2020. It recorded a loss in the quarter, less than expected, but wider than a year ago. But most interesting, it's kind of vowing to make a profit at some point this year, saying it will absolutely record an adjusted profit in one quarter. On the call, they're saying it could be as soon as the third quarter. I think the difference with Lyft, right, is they don't have that diversified business like Uber does. They don't have the Eats functionality. They don't have those other other bets really that they've been working on. So they've stuck to their core. They're confident they can be profitable on a lower volume of rides. And then when things recover, they'll have a much healthier, streamlined business as the rides pick up.
So let's move on to Twitter then. Also not great numbers. And of course, we are now post the banning of President Trump, who probably added some oomph. We don't know how much exactly. But what are you seeing there?
Yeah, so, Twitter recorded a fifth consecutive quarter where user growth was above 20%, but the outlook is really murky. They say in this current quarter, in the next 2 quarters, it will be in the low double digits, and that's really a drop-off in pace. And that's worrying because a lot of Twitter's revenue growth has simply been based on them growing their users. This earnings has really put Twitter into context for me. They have 37 million monetizable active users here in the US, but if you compare that to a Facebook or a Snap, it's basically nothing. Even Instagram, it's a very small proportion of the digital ad space that we're talking about, and that they think that that's growth is going to taper off. They benefited from the holiday spending when it came to ads, like their peers did. But the question that investors really have is, well, what's going to drive growth now? Will Twitter change to a subscriber model, like our colleague Kurt Wagner reported, sources saying that Twitter's looking at this week? And then there's the big question of the president, of course. President Trump no longer on the platform. How's that going to show up in the earnings next quarter?
Right. So what sort of understanding do we have of how big the Trump bump, if there was such a thing, actually is? I've interviewed Ned Siegel quarter after quarter, the CFO, and he's always sort of refused to say that President Trump has had any outsized impact on the service.
Right. Twitter's long defended this idea that the Trump bump actually has any direct impact on growing their user base. But they did acknowledge in the release that significant events, for example, the US election, played into some of the traction that the platform got. So those two things, the idea that there wasn't a Trump bump with the idea that the election drove traffic, seems a little incongruous. The reason it didn't show up in this quarter's earnings release is that the president was not removed from Twitter until January 6th. So we're not going to know until next quarter's earnings what the real impact of that in terms of a direct correlation of user growth. But you can be bet that analysts will certainly be asking that question of Twitter executives.
All right. Well, I will be sitting down with Twitter CFO Ned Siegel tomorrow, and I will ask that question. Ed, I know you're going to be listening in on the call momentarily. Thanks for breaking that all down for us. All right. Coming up, startup Aurora is partnering with the world's largest automaker and the largest ride-hailing network to make self-driving cars a more mainstream reality. We're going to hear from the CEO, Chris Urmson, next. This is Bloomberg. Welcome back to Bloomberg Technology. I'm Emily Chang. Well, self-driving upstart Aurora has agreed to a long-term strategic partnership with Toyota to mass-produce driverless cars and launch them on ride-hailing platforms, including Uber's, over the next few years. The company bought Uber's self-driving unit in December and is valued now at least $10 billion. For more, Aurora CEO Chris Urmson is joining us. Chris, great to have you back here on the show. So tell us about this new partnership and how it will work.
Well, it's wonderful. So Toyota is the world's leading auto manufacturer. We're going to have a chance to work with them, bringing the Aurora driver to their platform and ultimately deliver that to ride-hailing customers. And so we're extremely excited about the partnership and, aligned with their vision of mobility for everyone. So
the Toyota Sienna minivan was chosen as the first Toyota vehicle to have the Aurora driver. Why a minivan? Is the first use case a shuttle service or something else?
Well, I think when you think about easy vehicles to get in and out of for ride hailing, it seems like just an excellent platform for that. It's comfortable, it's spacious, it can help people get where they're going. So we think that's the right platform, and we're excited to get going with it.
So do you see a shuttle service or more of a ride hailing use case in this initial scenario?
So as we think about what the Aurora Driver is going to deliver to the market, it's a platform to move all kinds of vehicles. And as you know, a little while ago, we announced a partnership with PACCAR, one of North America's largest truck manufacturers. And so we expect our first application to be in large freight, these big Class 8 heavy duty trucks. And those will be operating on the freeway. And then we'll be working with Toyota and taking the Aurora driving capability that has this unique ability to see a long way down the road because of the special LiDAR technology we have, coupling that with the Sienna platform. And then, sure, perhaps applications are in shuttle services, but most or a significant fraction of ride-hailing trips actually require you to drive on the freeway to get where you're going. If you just think about, for those of us who live in the Bay Area here, down the peninsula and going up to San Francisco, you have to get on the freeway to get there. And so we think that combination of technology and great partnership will pave the way, a unique path for us to bring the Aurora Driver to market.
Now, Toyota is obviously the largest automaker in the world, so this gives you a huge high volume manufacturer. I'm curious about how the service then actually rolls out. Toyota is an investor in Uber. Uber is an investor in Aurora. How does the service roll out, and who's responsible for the fleet?
Well, I guess we think about it as bringing three of best in breed together. So at Aurora, we're focused on building the driver and then enabling our partners to build their businesses. We look at Uber as the world's leading ride-hailing platform, and then Toyota's the world's leading OEM. And you put the three of them together, then we can deliver an incredible experience to Uber's customers. We can make getting around safer, more accessible, and over time bring the cost of this down. And so we're really excited about that prospect.
Now, you mentioned some of the other deals that you've been making. With all of these deals stacking up, how confident are you about bringing autonomous cars to the masses, and when? I mean, it's one thing to have these cars out there in limited quantities, but it's another for them to be mainstream.
Well, that was the whole premise in founding Aurora, is that we were able to bring together this incredible group of people who had been working in the space for a long time, understood many of the challenges, and thus were able to bring the next generation of technology to market in the space. And so I think what you've seen over the last couple of months is, the kind of validation of what we've been building, and being able to align with one of North America's largest truck manufacturers. This amazing OE, the Uber platform, right? We can't be more excited about where this is going, and we're going to be bringing it to market as safely and quickly as possible. So look forward to more soon.
Now, there's been a lot of speculation just in the last few days about Apple's dog in this fight, or car in this race, if you will. You ran Google's self-driving car efforts back in the day. Your co-founder worked at Tesla. And you have to be thinking about the competition. I'm curious, how are you preparing for competition on the Apple front? Do you see them as being a formidable competitor in this race?
I think Apple is incredible at whatever they set their mind to, right? They're an amazing company. But I think for Aurora, we're really focused on building the best team, having the best technology, and then we'll work with anyone who wants to build their business, right? We think the power of the Aurora Driver is going to enable a lot of companies to build great businesses, and thus, a lot of people to benefit. And so, we'd love to work with everyone.
Does that mean you'd work with Apple?
Oh, absolutely. Of course we'd work with Apple. They're an incredible company.
And do you have any inclination as to how far away they might be from a self-driving electric car?
No, we spend our time focusing on what Aurora's building. And, as we kind of continue to accelerate, whether it's with the LiDAR that we now have that can see, we think further than anyone else can down the road, or the way we've combined machine learning with kind of conventional algorithmic approaches, we have conviction we're going to get there, quickly and deliver something that matters.
And the world, Chris, and transportation is changing, especially as we come out of a pandemic. And it's anyone's guess what new normal looks like, how much we're going to be in cars, in shuttles, riding a bus, for example. I'm curious what that world looks like to you, as we get back to some sort of new normal, but after going through this dramatic change.
Yeah, I think that the reason we have cars today is because it's convenient and efficient to get from one place to another. And whether we have a pandemic or not, we still need to get places. And so I'm a big believer that by making that underlying capability, whether it's to get goods through the world or get people through the world, safer, so fewer people are injured, fewer people are killed on our roads, making it more convenient, democratizing the access of it. Let's not forget that the cost of transportation is one of the largest costs for any one of us given day. Right? Making all of that safer, better, less expensive over time, right? That's going to matter in the future state of the world, and we're proud to be building a company that cares about delivering this technology in the right way to market.
So what do the roads look like in, let's say, 5 years, and what is Aurora's role on them?
Yeah, so in 5 years, we're going to still see a mixture of people driving cars and trucks and Aurora-driven vehicles on the road. We're going to begin with building, with our partners at PACCAR, trucks that can drive themselves, and they'll work from just off the freeway to on the freeway to getting back off at depots at the other end. And that will start to make it safer to move goods through the world. And in parallel with that, you'll start to see the Aurora Driver helping to move people through the world, and getting them from down the peninsula to up the peninsula, or across Houston or Dallas, right? And those initial applications will come to market. And then as we understand better how people need this technology to work, we'll refine that and continue to grow it in the coming decades ahead.
All right. Well, we will be watching and potentially riding. Aurora co-founder and CEO Chris Urmston, good to have you back with us. Okay, coming up, HBO's newest documentary, Fake Famous, out on HBO and HBO Max, dives into the rise of social media influencers and how not all may be what it seems. We're going to speak with the director, Nick Bilton, next. This is Bloomberg. HBO is out with a new documentary profiling the life of the rich and famous. Or are they?
More than any other occupation on Earth, kids in America say they want to be famous influencers.
When they look at these influencers and they think, wow, this is an amazing life, but people don't realize.
Most of the time, it's not real.
Should we do some cucumbers?
I love it.
But is that number of how many followers you have actual?
Fake Famous is taking a look at how easy it is to manufacture a fake online presence and portray your life however you'd like to the world. I'm with the director now of the documentary, Nick Bilton, also the author of a couple of books and longtime former journalist, I should say. Nick with us now. Nick, we're all sort of grappling with what is fake and what is real in the world of social media. And I'm curious what sparked this idea, because I'm sure you went into this with some hunch as to what you would find.
Well, I went into it with a hunch of what I would find, but I didn't know how this whole social experiment was going to work out. And as you know, I've been on the show many times before talking about tech. I've been covering this world for 15 years now, or something crazy like that. And I had written about bots and fake followers on social media, of course, during the 2016 election, covered it more then. And I had seen the rise of it happen with people, quote unquote, influencers wanting to be famous. And we had this idea, like, let's see if we can take 3 random people with no followers on social media. I could buy them a bunch of bots. We could do some fake photo shoots and see if they become famous as a result of it. And for one of them, it actually happened.
So how easy was it to make someone fake famous?
It wasn't that easy. It was a lot of work, honestly. You have to buy the bots. There are lots of different programs that you have to use. You're constantly having to buy likes and comments to make everything seem real. You're doing these photo shoots. They sometimes take a full day, and you get like 4 or 5 photos out of it. So it wasn't that easy, but the return on the investment was pretty astounding. I mean, we picked 3 people. I won't tell you what happened to 2 of them because you have to kind of watch the movie to see. It's pretty fascinating. But one of them, of course, succeeds, and she could literally tag a brand and on her Instagram, and they would just reach out and be like, hey, we want to give you free shoes. Take this coffee machine. Do you want a free mattress? Can we pay you? Can we collab? And it was completely wild to see this. And what I came away from it realizing is that the social media companies, do absolutely nothing to police it.
Well, that was my next question. Instagram, Twitter, Facebook, TikTok, they're not going anywhere. So, as they rack up more users, what is the point you're trying to make? What do you want viewers to learn from this?
Well, I think it's 2 things. There's one aspect of this, which is that 87% of kids today want to be a famous influencer. That is their dream job, right? 40 years ago, they wanted to be a doctor or a teacher or an astronaut or whatever. Now that is their goal. They want to be famous influencers, which I think is a pretty sad commentary on the state of society right now, especially when you look at the fact that most of these influencers, the quote unquote 140 million people who are considered influencers, most of them are not real. It's based on complete fake metrics. And then on the other side, you have the companies that are doing absolutely nothing to police this. There are hundreds of millions of fake accounts on social media. And the reason is because they get to pretend they have more users than they really do. If Instagram really cared and tried to kill this, they would probably have half of the number of users that they really have that they say that they have on social media.
So it's funny, we're reporting Twitter results today. You wrote a book on Twitter. What should the companies be doing? I mean, do you have a call to action here?
I mean, I think that they should take responsibility and actually police this. I think that the results are, it's not just about people wanting to be famous. Look, we saw it happen with politics. Donald Trump and Hillary Clinton both had, when they were running for election, both of them had half of their accounts, tens of millions of accounts that were fake, that weren't real. You have fake bots that are interacting, that are sharing fake news. There's the fame aspects, the politics aspects, all these things. And I think the reality is, at the end of the day, it is not in Twitter or Facebook or Instagram's best interest to solve this problem, because their companies wouldn't be valued at what they are, because they wouldn't have as many users as they pretend to have.
You also explore the psychological impact of this fame, and it's interesting because your subjects are all impacted by it differently. What is the takeaway there in terms of the impact on them? But then how should we also be thinking about the impact on the consumers like you and I?
Well, I think that the big takeaway for me when it comes to this aspect of it, one of the people that we follow ends up getting bullied online, and he closes his account for a period of time while we're filming this experiment. And of course, led us to look into social media and depression and so on. And when you look at the numbers, when the rise of social media is concurrent with the rise of teen depression, which is the rise of teen bullying. They're literally graphs that you can put on top of each other, and they show just how much these products and these services contribute to the problems that our kids face in society today. And I think that the guiltiest of all of them is Instagram. They really want you to see how many followers you have and how many likes you get and how many comments. Snapchat takes a complete opposite approach, and I commend them for that, where you don't see any of those things. But Instagram has made it a game, and every single kid who is on that platform has to compete.
Now, Instagram has said they've been trying to experiment and not show as many likes. I mean, have you not seen the impact of that?
They said that about 2 years ago when we started this project, that they were going to start experimenting with that. They rolled it out to a few different places, and then it just seemingly kind of stopped and went away. When we were doing reporting for the movie, it turned out that the reason that they had done that, from what we were told from people who work in the space, was because they were trying to serve up more ads. And so if you look at 10 photos on your Instagram and one of them is an ad, then you're only actually looking at 9 photos. And so then when they're upping it to 3 or 4 ads that you would see, you're obviously going to like less things. And then the numbers of likes that a famous celebrity gets is going to go down. So they were trying to hide those metrics. If they really cared, they wouldn't make the first thing you see when you click on someone's profile the number of followers they have. It is literally the most important thing to them to show that number. And I personally think it's devastating for kids that use the platform.
On that note, I'm very strict about my children. No faces on social media. I let them post a video on YouTube of making, some candy concoction in the kitchen. No faces though. But I can see just the impact that the rush of a couple of likes gives an 8-year-old boy. And I'm curious, you have kids. How should we be gatekeeping our children's access to these services, or should we be cutting them off completely?
I mean, I think that before I started this movie, my belief was that you should teach your kids when they're teenagers about the dark side of the internet. Now I realize you need to do it when they're 3, 4, 5 years old. I mean, it is something that needs to start early, very early on. And I think that the other thing is all of the tech executives that I've talked to over the last 15 years, none of them let their kids use their own platforms. Steve Jobs didn't let his kids use an iPad. Folks at Twitter didn't let their kids use Twitter or on YouTube and so on and so forth. And if the people building the platforms don't let their kids use them, then maybe we shouldn't be pushing our kids to do the same thing.
All right, Nick Bilton, really an excellent documentary, director of Fake Famous. Good to see you. Moving on to the other side, Nick, thank you so much. It's now available on HBO and HBO Max. All right, well, Match Group announcing it will acquire the South Korean video technology company HYPERCONNECT for $1.7 billion in cash and stock. This will help expand online dating and social features on its app. Since the pandemic, Match has been adding video tools like video streaming to its family of dating apps, the biggest of which is Tinder. HYPERCONNECT is profitable, generated more than $200 million in revenue last year. Coming up, we'll have more of Bloomberg Technology after this quick break. To some, Apple CEO Tim Cook may lack the artistic genius of his late predecessor, Steve Jobs, but equally important in Apple's transformation has been Cook's ability to usher in an era of outsourced manufacturing and made-to-order products. Joining us now to discuss his exclusive feature on Tim Cook, our very own Mark Gurman. And Mark, I remember the day that Steve Jobs passed away, and it was so hard to envision a company like Apple that would be anyone but Steve Jobs' company. But Tim Cook has, to some extent, remade the company in his own style of leadership. And I'm curious what you think are the most significant changes that Cook has made in his time as CEO.
Yeah, I mean, I remember that day too. Crazy day, obviously. And the first thing people thought was, who is Tim Cook? He was extraordinarily under the radar before he took over for Steve Jobs. And it probably took until 2013 for him to really make Apple his own. At the end of 2012, he did that leadership shuffle, elevating, Johnny Ive and a few other executives who are no longer there, and really putting his stamp on the company. He's made privacy and charity work really core values there. But more importantly to Apple as a business, he supercharged the idea of making, a Steve Jobs and Johnny Ive designed product by making it so it could be manufactured in quantities that you've really never seen before for consumer devices. And he did that by really relying on working closely with China and Foxconn and other factories there, Pegatron, Quanta included, and having Apple engineers on the line there, making sure that these things could be designed both in quantity and quality. And that really has been his mark on Apple. And you've seen that enable things such as expanded product lines. We have a stat in the story about how when Tim Cook took over, they only sold 2 iPhone models, whereas today it's 7. There was 1 iPad model when Tim Cook took over. Today there's 5. There's the Apple Watch. There's the AirPods. So he's really enabled that expansion with his manufacturing prowess.
All right, well, I don't want to give too much away because it's a really excellent piece in this week's edition of Bloomberg Business Week, so I'll urge our viewers to check it out there. But before you go, Mark, I do want to ask you about your reporting on Amazon's newest device. What is it? When is it launching? What do you know?
So I wrote this morning that Amazon's next major new Echo device is actually an Echo that mounts to your wall like a poster or a picture frame. It'll have a 10 to 13-inch touchscreen like a tablet. You can control it with Alexa. It'll have video chat. And it's basically an all-in-one smart home control device, an Echo for your wall. And I think it's going to be quite interesting to control your lights, your thermostats, and even play music and video chat from it.
Any expectations about how Andy Jassy will run Amazon's devices division once he takes over as CEO?
My expectation is he's going to be fairly hands-off on the devices division. As you know, it's run by an executive named Dave Limp, and he sort of runs that organization with free rein. Whereas, Jeff Bezos has a lot of high-level input on the devices side as well. And given his new executive chairman role, I'd expect, that devices relationship with Bezos to continue for the foreseeable future.
Okay. Mark Gurman, 2 great pieces out today. Thank you so much for stopping by. We'll see if your expectation turns out to be true. And that does it for this edition of Bloomberg Technology. I'm Emily Chang in San Francisco. Bloomberg Daybreak Asia coming up next. This is Bloomberg.